Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. On the Angelo Robles podcast, we look to distill the best practices and best ideas of among the world's most successful investors, families, and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of successful families and their family offices. Our session today is acclaimed investment strategist Lyn Alden on global opportunities and investment outlook for family offices. Of course, from the title, it features Lyn Alden, who's founder and CEO of Lyn Alden Investment Strategy. Lyn, welcome to the show.
Hey, thanks for having me. Glad to be here.
It's a pleasure. So to give everyone a little bit of context, I was familiar with Lyn going back about a year ago. We'll talk a little bit later about her newsletter and blogs, which were incredibly well written. She's an engineer by trade, so I think that mindset plays into it. I became even more familiar with her work over the last couple of months, and her writing is just, again, it's extraordinary. It's an honor to have her on. I've known and I've interviewed so many investment strategists, and until she does something to prove me otherwise, I think Lyn is my favorite. So it's an honor if to have you on the show. Let's go right into it. I really like to learn how people think. So economists, macro thinkers, investment strategists are usually a compilation of their education, their experiences, how they think critically, and focus their advice, assuming they're not a college professor, around data and available resources. So my question to you, what key economic indicators, data resources are important for you to kind of put the puzzle together?
So I blend historical information for a lot of my long-term context. So, things like money supply changes, historical monetary policy, fiscal policy, things like that, historical equity valuations, interest rates. And then, of course, I tie that into more up-to-date information. So what equity markets are doing, how different sectors are performing. I paid a lot of attention recently to currency markets because the dollar is such an important part of where we are in this kind of multi-year cycle. So I tie a lot of those kind of more timely data points into this like longer term historical context.
And how do you avoid confirmation bias and other biases? Among the smartest people I know, I'm based in Greenwich. I've interviewed like every big hedge fund manager. It's been a joy. And they're often the most intelligent and thoughtful people that I know. But inevitably, we could get into some of the issues later. I think we all fall into some level of confirmation bias. Even off the record, when we were catching up a little bit, we spoke about some well-known economists and thought leaders that are incredibly bright, yet I don't know, maybe the beginner's mindset has left them a couple of decades ago.
Well, I think one thing I do is just because, I am still pretty young, and I guess maybe this makes it easier to kind of always change, thoughts as it comes in. But aside from that, I try to follow people I agree with, disagree with, from totally different backgrounds, so that I'm always kind of aware of the counter argument, and that I'm able to articulate their argument in a way that, that I think that they would agree with. That kind of gives it the credit that it's due. And then just from, taking a numbers-based approach to things and kind of, every time I make an argument or make a, some sort of economic outlook, I try to tie it into data in some point. So if I don't have the data on my side, I inherently have to go a different direction. So a lot of times I'll start with a hypothesis that I think something's correct, but when I go about trying to justify it, I find that I can't. And then therefore sometimes I end up taking the alternative view, or that the outcome is simply, indecisive at the time. And therefore my original thought was most likely not grounded in facts. And so, but by having that really kind of enforced kind of numbers-based thing for every point I make, that really kind of just inherently gets you more towards truth whenever possible. And it's still always, of course, you can interpret things wrong. You could be looking at the wrong data set. So it's always important to just keep questioning where you could be wrong, what are the risks. And I think that's one of the biggest risks in the industry, because the investment management industry attracts really bright people, and so one of the biggest traps they can fall into is not that they're not intelligent enough. It's falling into the trap of being prideful, or just not being quick enough to iterate, or to realize to be able to strongly articulate an alternative view.
Yeah, I mean, emotions tie into it, past successes, and those are all understandable. We're not machines. We could argue the benefit of being machines, but we're humans, no matter how intelligent and how successful someone is. Somewhat a related question, but it has a little different twist to it. How do you have a beginner's mindset and know that the world is complicated and related to what I just said, illogical? And even the best processes and critical thinking, you're not going to be right 100% of the time. How do you understand what you did right or wrong, move past it, and move forward?
Oh, so part of it is making sure you define time horizons because a lot of times people have different opinions on how something's going to play out and they just haven't taken the time to sort out their time horizon. So you could have someone with a long-term view talking to someone with a short-term view and they're arguing past each other about what they think is going to happen. So part of understanding whether or not you were right or wrong about something is understanding your initial time frame because if your initial time frame was unclear, then it's at what point do you judge whether or not you were right or wrong? And so I think having that kind of predefined time frame helps you kind of go back and reassess things objectively. And then beside from that, just starting from first principles all the time. So starting from raw data and then layering narratives on top to help contextualize that data, add insight to that data, rather than starting from a narrative or starting from an idea and then finding data to continually back that up.
It reminds me of something. When I consult to family office executives, I often recommend to them that they journal. They maybe keep a personal journal and a business journal. And I want them to think through their processes of how they made a decision. And their decision may end up being wrong. We're never right 100% of the time, but they should understand by reflection at the beginning and or end of the day. And then I think at the end of the week and look back and compare. Are they developing a beginner's mindset? Are they getting set in their ways? What are the confirmation biases? Do you like, and given you're an engineer by background, I'm assuming journaling or keeping track of how you thought about a decision is helpful moving forward?
No, I think so. I think, for better or worse, I mean, my journal is incredibly public because my work centers around writing. And so I have, timestamped newsletters, I have timestamped premium reports. And so the archives are available so I can go back and look through them. Sometimes if I'm updating a view, I'll go back and look at what I wrote about that sector or that particular type of company before to see, sometimes it played out. I see if that thesis is still correct. Sometimes it did not play out, so I see why not. So, for example, a couple months ago, I was reviewing one of my past energy stock picks, and just going back. Of course, that out of all the stocks this year, that would have been one of the worst ones to go into the year with. And so I basically went back and reviewed, like, okay, is the fundamental thesis still good? How much of the downside in that move was due to, kind of just the valuation going down versus the actual fundamentals, and just kind of going back and having that archive available helps. And so if I didn't have that, I would be more interested in just kind of private journaling, just to go through it and make sure I understand why I made investments, what my thought process was at the time.
And again, I'm big on kind of how decisions are made. So we're pounding this one a little hard. How do you think through that there's tons of information? If you did nothing else but look at smart people who write, talk, or do videos, who produce charts, you'd be doing nothing else but looking at those things all the day. How do you know what to choose? And more importantly, the real question, how do you interact with that information and think through the probabilities?
Yes, I think part of it is understanding what you have an edge in. And so if you try to do everything equally, you're going to be pretty much mediocre at everything. Whereas, kind of defining your own strengths and weaknesses and making sure you're very clear about what you're trying to do makes it easier to filter out information. So, for example, with myself, because I have a long-term view for most of my investments, I can filter out most of the short-term noise, a lot of the high frequency stuff. And that kind of keeps me focused on data that will affect the long-term outcome of the investments I make, rather than kind of trying to manage both the long-term and the short-term simultaneously. So I think that's the biggest thing is just kind of making sure you know what your target is so that you can disregard information that doesn't strongly, result whether or not you're going to hit your target or not.
And again, these questions are all somewhat interrelated, but your perception of them and your answers, I think, are unique and important for my members, my listeners, my viewers to understand. Do you have mental models for making decisions and a process that you follow?
To some extent. So because my background's initially in engineering, I think of things for the most part in terms of control engineering. And so kind of take into account kind of a framework for all the inputs and outputs, and then having feedback loops, so and response outcomes. So for example, if X happens, then what is the policy response Y that's likely? And kind of also finding if else situations. So like we know that an outcome is going to happen. We don't know specifically what direction it's going to take, but we can form very clear things like if it goes this way or this way, what are the things that are almost certainly likely to happen from either of those two outcomes? And then therefore you know what to do ahead of time if that outcome occurs. So kind of having that, trying to find points that are binary wherever possible.
In the war room of investing, sometimes logical and what should happen is not what happens in reality. I could argue behavioral finance, human emotions, etc., come into play. And ever lurking, courtesy of our friend Nassim Taleb, are black swans. So thinking through practical advice, when do you hedge your bets? When do you take some profits off the table? And simply, when do you just admit, I was whipped, I'm wrong, let me stop my losses here and move forward? Are these things that an investor should all think through?
Yeah, I think so. I think, and there's two kind of broad separations to that question. So one is taking profits and things like that. I look at a variety of, overbought indicators, oversold indicators to try to, see where price would affect something where I want to take some profits off the table. Like, I might trim my tech stocks, I might trim my copper stocks because they've done very well. Whereas I might stick with some of my things that, have lagged a little bit this year. On the other hand, the main thing about determining whether or not you were right or wrong, at least in the type of investing I do, is watching the fundamentals outcome. So, the quarterly reports, the annual reports, and if a company is just not growing at the rate I expected, or if they announce certain bad news or a change in strategy or something that didn't align with my initial vision of how that investment's going to play out, then I have to go back and reassess and just kind of start over and say, okay, is this attractive at the current price level, the current fundamentals, or is it deviated so far from what I'm expecting that it's clearly time to cut losses and move capital to somewhere else?
I think it's important for someone looking at the world and all the asset classes that you are. Obviously, you need to be a macro thinker, but it's so complex in today's world. I would like to cover with you a couple of bigger picture monetary and macro items before we get into, the juicy part of asset allocation, asymmetric bets, and where there could be opportunity. Why don't I start with monetary policy, specifically, I would say, in the United States, that compromises the Federal Reserve's actions and communications to promote maximum employment, stable prices, and moderate long-term interest rates. Then that would intersect with what we would call modern monetary policy. If you could, and again, I know we could do hours on this. We probably have about 39 questions to get to, but if you could give your opinion of that and help to set the stage.
Yeah, so it's one of those things where, now that the Federal Reserve is over a century old, we have, over a century of historical data for how they behaved. And so one the context I found most useful for understanding their actions is the long-term debt cycle. So that was popularized by Ray Dalio, and then I've incorporated that heavily into my own research, done my own kind of rebuilt my own models, for that, and kind of look at it separately. And so the concept there is that you have the short-term business cycle, you have the 5 to 10 year credit cycle, boom bust cycle, and so during that process, you get more and more leverage building up in the system. Usually, you have the Federal Reserve trying to raise rates, and then something happens. Either the rates themselves eventually kind of squeeze the system, or you get some sort of external shock, and then you get a recession, a deleveraging event, and then policymakers come in, they cut interest rates. Usually, you also have fiscal response as well. And so that short circuits the deleveraging event. And so leverage starts to go down, but it never goes back all the way to where it was at the beginning of that cycle, and then starts to build up from there. And so when you string multiple of those short-term business cycles together, you get the long-term cycle, which is basically that you get higher and higher debt as a percentage of GDP, and you get lower and lower interest rates. And that compounds over time until interest rates hit zero, or in modern cases, some countries, slightly negative. And at that point, there's really not much policy room to go lower, just because the way interest rates are designed, they can't really go too far negative. And so then you get a much different set of tools, and you're at extraordinarily high debt levels that threaten the system systemically, because they could have potentially stopped those from building up in the first place, but because they in some ways encourage them to build up, now they're kind of stuck in a corner. And so historically, the last time we hit the zero bound was in the early 1930s. And then in the modern cycle, we hit it, right after the global financial crisis. And those two periods marked the end of the long-term private debt cycle. And so a lot of basically a lot of my framework goes back to thinking into account, what's happening now, what's happening in a given FOMC meeting, what's happening there. But then I'm also zooming back out, looking at a 100-year chart and seeing the long-term debt cycle and seeing the breaking points. And I think that's a lot, that's the thing that not a lot of analysts do, because, they would consider long-term to be like a 20, 30, 40-year history. But, without having that century view, that basically analyzing the 1930s and 40s to see how this played out last time, even though technology was different, policy was different, there were a lot of different things that we're working through, it still is in directionally important, I think, for analyzing the current environment.
I mean, I would say there's broadly three instruments, monetary policy, open market operations, the discount rate, and reserve requirements. How does that kind of interplay with what we call modern monetary policy?
Yeah, so there, for the most part of that cycle, adjusting interest rates would be the main thing. But then what characterizes the end of a long-term debt cycle is that's when they bring in open market operations, asset purchases, essentially QE. So that's where you get, what is essentially a currency devaluation in some ways. And so we saw that back in the 30s and 40s, and we saw that, in this recent kind of 12-year period since the crisis. And so that's the main difference there. And of course, all sorts of different regulations for banks also ties into that. So banks were highly leveraged going into the 1929 crash, and then highly leveraged going into the 2007, 2008, crisis as well. And so, from there, they do all sorts of different requirements to try to shore up the banking system, usually combined with asset purchases, because they're so leveraged at that point that there's virtually no way, even though one bank could potentially deleverage itself. If every bank simultaneously tries to deleverage itself, there's nowhere for those, for them to collectively build up cash levels or sell assets too. So that's when you see the Fed come in and adjust balance sheet levels to basically, help banks enforce the requirements that the Fed has just imposed, or that in some cases Congress has just imposed. And so that's kind of basically, as that long-term debt cycle progresses, we see the dominance of different types of their tools. And that's one reason I think why, because a lot of people were shocked by asset prices and things like that during this past 12 years. But for people that were really kind of looking at that long-term historical context, it's less surprising to see. And it's almost like you can see them checking off, parts of the playbook like last time. So you kind of say, okay, what happened? What's next? And seeing how it kind of fits that playbook or deviates from it.
And I mean, I guess this goes back, we'll go way back to 1944, a little town and I guess hotel as well in New Hampshire called Bretton Woods. And there's a little bit of controversy around that. We'll probably get into that in early January when I have Jim Rickards on, as he has written about it in his books with Harry Dexter White, the US representative. And some say, and there's a fair amount of evidence relative to potentially being a foreign spy, and the legendary Keyes himself from Great Britain, and effectively the US, or Harry Dexter White's representation of monetary policy moving forward, won out. We can't go back and know how it would have played out with Keyes, but in general, from what you just said to now, that's been like almost 80 years ago. Is this something that needs to be adapted? How has it worked? Today's world is totally different.
Yeah, so it's actually, I mean, it was radically changed in the early 1970s, as most people know. But yeah, essentially, so that debate back then was, the Keynes view, and just to step back even further. So of course, prior to then, multiple currencies were on the gold standard. Multiple of them had to, temporarily suspend their gold pegs or devalue their gold pegs due to the end of the long-term debt cycle that preceded that, and due to the war. And many countries shipped their gold to the United States for safekeeping during the World War. And to the United States, after having confiscated gold from citizens. I mean, they paid for it, but they basically forced all citizens to turn in their gold. And they also had custody of foreign gold. They were by far the world's largest gold holder, the largest creditor nation. And so they had a lot of political power, of course, for setting the next system. And during Bretton Woods, the two main proposals, Keynes' proposal was that basically, central banks create some sort of neutral reserve asset that could be used to settle international trade, which would be called like a bancor. And so that would basically be a basket of multiple currencies that was basically, kind of representing global money supply, and banks would hold that on their balance sheet. The United States position was basically that the dollar would be pegged to gold, and other currencies can peg to the dollar with fixed exchange rates. And that's a system that won out. And then, of course, we had economists like Robert Triffin argue pretty early on that this wouldn't work, that that eventually this system would break because U.S. foreign liabilities, dollars and treasuries that are basically redeemable for that gold, would outnumber the amount of gold that the U.S. can use to back its currency and its foreign debts. And that's exactly what happened. If you look at over the next 20 plus years, that system started to unravel under the surface, even though it continued to function on the surface. So you started to see that the United States' foreign liabilities began creeping up and eventually exceeding the gold holdings they had. The United States gold reserves kept going down due to redemptions, and eventually the system broke in 1971. And so that it decoupled the dollar from gold, and it rendered this world of floating exchange rates. And then they moved on to the next system, which it has a couple different names, but essentially the petrodollar system, which is that United States made a deal with Saudi Arabia and others that they would only price their oil in dollars, and therefore that created global demand for dollars. In the sense that if France buys oil from Saudi Arabia, they pay in dollars, even though the dollar is neither of their currency, for example. And then so you get many countries price their goods in dollars just so they can get dollars, so that they can buy oil and other commodities as needed. And so that gives United States a position where compared to our GDP or compared to our percent share of global trade, we have a disproportionate usage of the dollar for international trade, international reserve holdings. And this has had a variety, it in some ways it benefits the United States because it extends hegemonic reach. But on the other hand, it also basically forces us to run persistent current account deficits, and basically forces those current account deficits to be open most of the time, which is basically a reformulation of the problem that Triffin argued, back in the 50s, essentially.
And all this intertwines with effectively central bank policy in the US. We call it the Fed. And I guess the primary role of central banks is usually to maintain price stability as defined by mainly specific levels of inflation. So we set a little bit of a stage for monetary policy of Bretton Woods, and now transferring a little bit to the role of central banks in today's world.
Yeah, I mean, because of where we are in the system, many of them have, they brought interest rates to zero, in some cases negative, and they're also doing large asset purchases. And so back in the 2007, 2008, 2009 period, a lot of their actions were based on recapitalizing the banking system. So banks went into that crisis, like speaking from U.S. banks now, U.S. banks had something like 3% cash as a percentage of assets. So there were very, very low reserves, very low allocation to safe assets, because they were making such highly leveraged bets on the real estate industry and corporate loans in general. And so when that blew up, the Congress and the Fed, they imposed higher reserve requirements. But then in order to supply those reserves, first they did the troubled asset relief program. That was a fiscal and monetary kind of blend. And then on the monetary side, the Federal Reserve would, create new bank reserves, buy existing treasuries, mortgage-backed securities from those banks, and that basically filled them up with cash so that they could meet the higher reserve requirements and operate from there. And then that shifted in recent times more and more towards what is arguably debt monetization, which is essentially that fiscal deficits for many countries are so high that there's not enough real demand for their treasuries. And so even though the central banks in most cases are not buying directly from the fiscal agent, they're buying enough on the secondary market that they're sucking up a lot of that excess supply and helping to manage interest rates in that way.
And how does this interplay with the role of the Treasury?
So the main difference between the central banks and the fiscal side with the Treasury is about basically diversification of power. So the Treasury, they issue bonds through the Fed, And so they have the power to mint physical currency and to basically do the will of Congress, things that are passed by the Congress and the president. Whereas the Federal Reserve manages the banking system, and they do a lot of actions on behalf of the Treasury. They basically serve as the bank for the Treasury. And now, what makes this part in the long-term debt cycle different from normal is that for the most part, you're supposed to have a completely separate central bank from your Treasury. You're not supposed to have them shared together because then there's so much power kind of blended together. And you basically have the power to then just do whatever you want with the currency. And then that's where you get kind of the Banana Republic currency devaluations that we're all familiar with. So that separation of powers, central bank independence has been a kind of a hallmark of developed markets. But if you go back, for example, to the 1940s, which is basically where we were back then in the long-term debt cycle towards the end of it, you basically had central bank and the Treasury partially merged together essentially. So because the deficits were so large, the central bank ended up buying a lot of those treasuries and also doing yield curve control to lock yields below a certain rate. And the way they do that is that they are willing to basically buy as many treasuries as needed to maintain the peg at whatever interest rate they set. So regardless of what inflation does, they're able to hold that rate low. But of course, the release valve for that is the currency. You get a currency devaluation. And if you fast forward to 2020, we started to see them working together in ways that are basically closer than any time we've seen since the 1940s. And the main thing was the special purpose vehicle that allowed the Fed to buy corporate bonds. And so normally the Fed can't buy corporate bonds. It's not part of their charter. However, with the Treasury, they were able to do a workaround. So they opened a special purpose vehicle that was funded by funds from Congress. And so the Fed could essentially buy corporate bonds, but they hold them on that special purpose vehicle, and any nominal losses would be recouped from the funds that were set aside. And so that's where you see that the Fed has limitations and the Treasury has limitations, but if they work together, they basically transcend most limitations, but that of course opens up risks to the currency.
Yes, it sure does. And I will add on Lyn's website, and I believe it's even free content. Oh, it's only probably 50, 60 pages. It's the best I've ever read at intertwining all of this together. What do you remember calling it, Lyn? So those that may want to look it up after the podcast could read it.
So I have a couple there. One is the fraying petrodollar system, and the other one is all about money printing. So I can get the title here, but those have been some of my key long form recent pieces.
They're utterly fantastic and acclaimed worldwide. So if you haven't read it, and I would recommend for family offices, their CIOs, that their children, it really, just like Ray Dalio's work on the long-term debt cycle, Lyn's work on this has been fantastic. While you're looking it up and weaving this together, the IMF was, I guess, born out of Bretton Woods. And what is its overall role and the interplay with central banks?
Sure. And just to answer your previous question, so the articles that really tie into all this, one is called The Fraying of the U.S. Global Currency Reserve System. One is called Banks, QE, and Money Printing. And the other one is called A Century of Fiscal and Monetary Policy, Inflation versus Deflation. And that goes into the long-term debt cycle. So those three pieces tie into a lot of what we said here. So for people that want the text and the charts, that those are pretty helpful for this. The IMF is just a key organization that helps kind of reinforce the dollar status as currently used. And so the most thing it's known for is assisting with emerging markets that basically run over the skis in terms of dollar-based loans. And so, in the initial version of this global financial system that's been in place, especially since the 70s, is that so in addition to all oil being priced in dollars, essentially, a lot of global financing is priced in dollars. So a lot of these emerging markets who, that other countries don't want to finance in their local currencies, many of them finance them in dollars. And so you start to get a lot of dollar denominated debt out in the world. And so that kind of contributes to the network effect of the dollar being the global reserve currency, because all of that dollar denominated debt represents demand for dollars to service those debts. And so that's where we see whenever we have solvency issues or liquidity issues, we generally see a strong dollar spike because all those entities internationally are trying to get dollars at the same time. And of course, the issue you run into with emerging markets is that if they get into a position where they have too much dollar-based debt and they don't have enough foreign exchange reserves, then they are very exposed to periods of dollar strengthening. And so one of the purposes of the IMF is that they come in with dollar-based loans and try to alleviate that situation. But of course, that ends up being very controversial because they impose certain measures on those countries in exchange for them accepting the loans. And then, of course, there's debates about how effective those measures are, whether or not they help address the problem or make the problem worse, often a mix of both. And so it's basically it's one of the kind of safeguards to the system that we're familiar with as part of this this kind of global monetary framework that we've had for the better part of a century.
And when you look at the dollar as being the world's reserve currency, and it looks like it's going to be that way for a while, but I guess you arguably have some contenders, the Chinese renminbi, the euro. I don't see it. If you want to get a little more fancy, potentially Bitcoin and baskets of gold, maybe a collective, and what some would argue, a secret of the IMF SDR currency.
Yeah, so I agree with you. There's really no kind of easy contender. The euro and Chinese currency are really not in a position to do what the dollar's done for the past several decades. One of the problems now is that the dollar is really no longer in a position to kind of keep doing it, because one of the arguments I've made is that the United States, when Bretton Woods was formed, the United States was something like 40% of global GDP. And then even when that system ended and the petrodollar system began, the United States was something like 35% of GDP. But over time, because Europe and Japan rebuilt after the war, and then in later decades, because we had the rise of China and other emerging markets, which contain most of the world's population, we've had a overall long-term decrease. So the United States is now something like 20 to 25% of global GDP, depending on how you measure it, or as low as 15% if you look at purchasing power parity. And so the United States is really no longer a big enough trade partner or commodity importer to keep this current petrodollar system operating smoothly. And so that's where we've kind of seen various breaking points, especially over the past 5 to 10 years. And so there's been all sorts of proposals for ways to go around that. So if we go back to what we discussed, the Bretton Woods system, Keynes' Bancorp idea, that was later introduced in the late 1960s by the IMF in the form of the SDR, the special drawing right. And so what that essentially is a version of the Bancorp. It's a basket of major currencies that central banks can hold on their balance sheet. And it's kind of, it's not like medium of exchange currency, like you and I can't use it for spending, but central banks can hold it as a reserve asset and theoretically could use it to settle trade. There were some currencies that were pegged to SDRs. And so that kind of resurrected the idea of a Bancorp, but it never really took off. It was always kind of outdone by the petrodollar system and the dollar-centric system we've had. But we've had kind of renewed calls. So Facebook, back when they announced the idea of a Libra, that was essentially a private bank or a private SDR. So the SDR is, it's the IMF. It's a super government organization issuing this. It's something managed by the central banks. Whereas Facebook was proposing a private version of that, where they would use, basic cryptocurrency technology to wrap a basket of currencies and make this kind of tradable unit that is essentially a Bancorp. So that was one idea. And then one of the most notable events was that Mark Carney, the previous governor of the Bank of England, he proposed something like something like a digital Bancorp or a digital SDR, which is that moving towards this more multipolar system of having some sort of neutral reserve settlement asset. And then, of course, you get into whether or not gold could fit into that basket, or whether or not you can have kind of regional Bancorps. So, one thing I point out is that we had that big trade agreement between those 15 Asian Pacific nations in recent weeks. And it's possible that any sort of big trading group like that could introduce some sort of stable coin or some other basket that represents some sort of neutral trading vehicle rather than using any one currency. And so it's just basically a trend or a technology to be aware of, because stable coin, cryptocurrency technology, whether introduced by private entities or by public entities, potentially resurrects the idea of an SDR or a Bancorp with that new technology.
It most certainly does. And again, we could probably spend hours and hours on these subjects. They're great. And for the audience, I know they often want, asset allocation ideas, asymmetric bets. That's all great, but without a foundation about how you reach a thesis and how you make decisions. And that's why macro thinking is so important. I think it's important to kind of lay a strong foundation. You brought it up. I was thinking maybe I would cut it off because it's not going to be 3 hours. But Libra adapted their name to Diem, made some adjustments, but a little bit of a surprise to people appear to be moving forward and not being necessarily told no yet by the government. Do you think governments are watching this to kind of see, interesting? And if it starts to take off, we could always ban it. I'm really intrigued as to how this will play out. I probably don't want to make it an hour discussion about Diem, but if you want to give your comments, I'd love to listen.
So one thing we can look at, based on documents or statements released by several central banks, they do seem more concerned about stable coins than they are about, say, Bitcoin, for example. Stable coins, they really kind of get to the heart of their system a little bit more than some of these other technologies. And so the Libra was an obvious case of that. And so I think from their end, I think they see a degree of inevitability here. And so they'd rather have entities that they control or that they can regulate easily be the dominant roles there, rather than trying to stop those big entities from doing it and having smaller, kind of harder to regulate entities going around it. So I think that might be one of the things they're thinking, but it's a space I continue to watch.
Very much so. I'll do an Angelo sidebar for a second. If you're a single family office and you're not getting more fluid with digital innovation, and I don't want to hear about, I don't invest in what I don't know. Here's my response to that. Start to know. Put in 20, 30, 40 hours, read, talk to key thought leaders, read some of Lyn's work. If you're not going to be active in what's happening in this part of the community, what I'm broadly calling digital innovation, and you may make a decision to say, I did my research, we're going to stay on the sidelines, but at least you're making an informed decision. I think there's going to be tremendous opportunities in what I'm broadly calling digital innovation. And you're going to miss out if you're not at least making an informed decision, which unfortunately, per the research and surveys I'm doing, the vast majority of family offices are sitting on the sidelines. I think they're wrong. Okay, I'll get off my high horse.
And that's just to add on to that. Back in 2017, for example, I finally got around to researching digital assets. And back then, my decision was to stay on the sidelines, and so that could be a perfectly valid conclusion if you go to it. And so I did the work, I got into the space, I looked at what was going on, and I saw that there was a lot of potential there, but also a lot of euphoria. And so basically, I said, okay, it's something I'm going to start watching now more closely, but I'm not taking action yet. And then it wasn't until I slowly continued adding to my base of knowledge, and then by early 2020, when we had this big liquidity sell-off. That's when I decided to take action. So by starting that research early, even if you decide that you're going to stay on the sidelines for now, if there ever is a kind of a future opportunity where something changes, you already have the homework in place. You already have the foundation in place, so that you can then move more rapidly if something were to turn and make you more favorable to the asset.
Absolutely. And it's not just digital currencies, but that's very important. It's the blockchain, the power of that, and digital innovation through stable coins, through NFTs. It's a little complex, but if you put in the time, I think it could pay off, even if it simply is we're making a decision to go into sidelines. Here's what I think you're going to see with some multi-billion-dollar single-family offices. I think I'm pushing it a little bit because I'm writing about it. You're going to start to see family offices and CIOs in family offices hire people specifically to look to allocate 1% to 5% of their portfolio, or maybe a part of their venture portfolio or their cash towards these. And they may realize that they're not in position, maybe at their age or their experiences, to make these decisions. So they're going to hire people or form investment committees that could. It's coming, trust me. Legendary investor Jeffrey Gundlach. I'd like to read something. It's a pinch long and it's a little negative, but let's throw it out on the table. He states, we are close to monetizing our fiscal deficit by creating unlimited lending facilities. Monetization, which he defines as full money printing by the Fed, would violate its charter. Monetization always leads to hyperinflation, according to Gundlach. as it did with the Weimar Republic in Zimbabwe. It also leads to social change, potentially a bloody revolution. I'll skip ahead a little bit. Either by default or liabilities, like raising Social Security eligibility or devalue, according to Gundlach. Wow. I mean, he might be right. He's been right and he's been wrong. No one's perfect. But that's a little bit of a stark statement in terms of what sounds like a bleak future. Tell me where he might be wrong. Make me feel better.
Yeah, I guess so. In principle, deficit monetization opens up the door to hyperinflation. So that basically is the door that kind of goes into
which we haven't had forever.
And so that, that's certainly a risk. Now, it doesn't necessarily follow that if you do that, it leads to hyperinflation, because in theory, you could pull back, you could do it to a limited extent. But it's just one of those things that once that door is open, historically, that gets abused until you do hyperinflation. Now, there are also softer forms of deficit monetization, and there's even been debates about what constitutes deficit monetization. And so the most direct term would be that the treasuries are issued and they go directly on the central bank balance sheet and the central bank basically creates new bank reserves. They buy those, but instead of going to the commercial bank system, they go directly to the Treasury. And so you basically are just printing money to fund U.S. spending with no intermediary, and you're just going around all the safeguards. And so that opens up the door to just, if there's no limit to spend, if there's no kind of market limit, then we just spend, and you eventually get a hyperinflationary response because it's hard to pull that back once it starts. Now, a softer form of deficit monetization is essentially what we've seen over the past decade in many places, which is that the central bank, instead of giving money directly to the fiscal authority, they buy on the secondary market. And so the Federal Reserve creates new bank reserves, and they keep buying sovereign debt, but they buy it on the secondary market. And so that still, essentially is a form of deficit monetization, because that means capital is being put into the economy that wasn't really extracted out from the economy. And so it tends to be somewhat more inflationary, but it still has safeguards, right? So there's still the market in some degree of pricing there. And we basically have ways to measure it. How much is the Fed forced to buy? And so Congress can still pull back and still kind of, trim their budget, adjust their taxing and spending situation to address that. And so I would, there are others too. Like I remember Lacey Hunt, for example. He's been a long-term deflationist, and he argued that essentially if you change the Federal Reserve Act and you get directly to deficit monetization, even he said that would be hyperinflationary. And so that's the event where some long-term deflationists would be very concerned about inflation. And I think one of the biggest questions ahead of time is if they do enough of that soft deficit monetization, currently working within the system to basically monetize as needed, will they ever end up opening that other door? And so I think we're going to see in time, but for now, with that door shut, with the Federal Reserve Act the way it is, we're on kind of a more gradual track rather than the more hyperinflationary track.
I mean, I think I read in some of your comments, you're familiar with the author Neil Howe and his paradigm of fourth tuning. Gundlach talks about that. I think even Rickards as well. We won't do a super deep dive, but basically every 75 years, there's, according to history, and again, things change. I'm not saying it's going to stay that course forever. But they talk about democracies, quote unquote, don't survive. They fall back when there is too much wealth inequality. And right now we do have a bifurcation. We're seeing it to some degree during the social unrest. And this has always been a very, very touchy subject. And again, I represent, single family offices, the most extreme of the wealthy, but they do know to have a functional society, to have a world that their children and grandchildren can live in, they need to understand history. They should be very familiar with Neil Howe's work. And we could argue creating equal educational opportunities. So I'm asking you a very, very tough question, more commenting than a question. But looking at that issue of wealth inequality, we could be heading down a very, very tough road. You eloquently write about inflationary periods of the 40s and 70s, and there might have been some equity redistribution among the wealthy during those periods. And again, he's another subject we could go on for 2 hours, but in 2 or 3 minutes, I'd love to hear your opinion.
Yeah, so one reason I focus so much on the long-term debt cycle is that all of the identified long-term debt cycles in American history that tend to happen every 50 to 100 years, they all correspond to what Neil Howe marked as the fourth turnings. And I don't know if you knew it at the time, but essentially that's where you get kind of rapid institutional level change because you basically end one paradigm and you shift to another one. And so, of course, the previous one was the 1930s and 40s. The one before that was, unfortunately, the Civil War. And the one before that would have been the Revolution.
In other words, violence and chaos.
It tends to be, yeah. And so as we go forward, this fourth turning, which is in Howe's work in that cycle, and we're based on the fiscal monetary policy, we're in the long-term debt cycle kind of part as well. It is something that, seeing social unrest is something to pay attention to. Historically, at those periods of long-term debt cycle, that's when you get rising populism. And it's important to note that, so we often think in terms of right versus left, but then you get a more complex political landscape because you have populist versions of the right and the left. And so you almost kind of think of it in terms of quadrants. You have, populist right, populist left, established right, established left. And those are kind of the big quadrants of political forces that end up happening in these sorts of contexts. And historically, right, towards the early phases or leading up to a long-term debt cycle peak, usually you get a very rapid period of wealth concentration. And so that's, basically measured as, what share of assets are owned by the top 1% or the top 0.1%, and how does that compare to, say, the percentage of assets owned by the bottom 90%? And historically, in those periods, you do have a very high degree of wealth concentration. And then usually after the long-term debt cycle, usually you get some sort of redistribution that lowers that. And often that takes the form of a currency devaluation because, it can also take the form of taxes as it did last time where we had very high top marginal tax rates, in the 40s, 50s, 60s. But in addition, it can take into account currency devaluation because for investors that are, say, working class and they have, say, a home with a fixed mortgage on it, and that represents a very large share of their net worth, that tends to benefit from inflation more so than large holders of bonds, cash, equities, things like that. And so when we had the two really big inflationary periods of the past century, which were the 1940s and the 1970s, those tended to be periods where wealth concentration went down. And that's because essentially, in the 40s, it was for very different reasons. So in the 40s, stocks did very well after they're roughly bottoming in 1942. In the 1970s, of course, they did very poorly. So there's a lot of different mechanisms as to why that is. But the things that they both shared in common was that was kind of a part of the redistribution that happened during that part of the cycle. And this is something to be aware of when managing your assets.
Somewhere in the back of my head, do 1% of the world's population own 52% of the stocks?
That's, yes, from memory. That's the chart I did before that showed according to the Federal Reserve, the top 1% own 52% of stocks, and the top 10% own 88% of stocks. And if you look at broader assets, net worth in general, it's a little bit lower than that, but it's still fairly concentrated in the top 1% and to some extent in the top 10%.
And I mean, even Rickard spoke about this, and I'm a libertarian, so not easy for me to sometimes say some of this, but I mean, he writes about taxing the rich. Much of the wealth of the richest Americans is really never taxed. It's set up through dynastic trusts where wealth is passed on. Real estate could be an incredibly beneficial tax vehicle, and stocks until you sell them or their step up in basis when you die. He also writes about that also families set up foundations. Now, again, I represent the families. I talk about all these things. I talk about international structures and only paying what you're legally required to. Yet there are times I think about it and I talk to families very strategically when, what is our world going to look like? This may all work and I'm giving you this advice, but in 20, 50 or 100 years, if there's an incredible bifurcation, the masses will always win the political aspects of it. And this could lead to revolutions and things that we're talking about. Again, I know this is probably not the discussion that most people want to get to emerging markets and Bitcoin and all that. But I think, again, this is really important to understand.
No, I think so. Basically, whenever you get these fourth turnings, long-term debt cycles, whatever you want to call them, there is certainly heightened geopolitical risk, social political risk as it relates to assets, and that's always been the biggest kind of tail risk for very wealthy families, multimillionaires, billionaires is revolution, asset confiscation, war. Those kind of large tail risks have always been kind of the rare but devastating things that can happen to a very large asset base. And so taking those seriously is certainly one of the ways to manage your wealth. So it's not just looking at what's going to happen with equities, what's going to happen with gold, what's going to happen with bonds, what's going to happen with Bitcoin. It's also about what's going to happen with jurisdictional risk as it pertains to tax policy or other things that can kind of go around any of your returns and attack them in some way.
Yeah, I mean, I'll put back on my libertarian hat now. Governments confiscate your money all the time, including in this country. It's called taxation. And they could band together, depending on the power of the party, and really up those taxes a lot. And I know it makes some people feel uncomfortable, but it happens here, civil forfeiture. And sometimes it does get political. We see it in other countries. It could happen here. A little off topic, but going back to what we said a minute or two ago, and I want to tie this in a little bit to digital innovation, and that would be central bank digital currencies. We read a week ago that the CEO of Citi is admitting that they're working with a foreign government, helping to create a central bank digital currency. And I admit, because I'm active in digital innovation, I'm intrigued by it. It would make things incredibly efficient, possibly taxation, distributions. But because it's a centralized network on that blockchain, the big brother aspect, it's not making me feel too warm and cozy.
Yeah, you can see from their perspective why they want to do it, because
for sure,
power always wants more power. So they want to have more tools as possible to manage the currency. They want to apply technology to enhance their tools, and so that digital currencies address a couple of concerns that central banks have. One is it frighteningly allows them to go potentially into deeper negative territory for interest rates, because one of the reasons why they used to call it the zero bound and now they call it the effective lower bound, is that basically if interest rates get so negative, there becomes an incentive to basically pull physical cash out of the banking system. And so that's why they can't really go much more negative than a nominal small amount. But if they were to effectively ban cash and have an all digital currency system, it makes removing value from that system very challenging, and that gives policymakers more leeway to go deeper into negative territory. And then in addition, the way that the currencies could be structured, the digital currencies, is that essentially it gives them more insight onto who owns that particular unit of currency. And therefore, they can do things like they can impose different interest rates based on different situations. So instead of, they basically can affect and say, okay, if you have over a certain amount, your interest rate is different than someone who has less. If your age is a certain amount, if things like that, they can do targeted stimulus so that, everybody gets stimulus, but then the money expires in 3 months. And so it has to be spent within that period or it's forfeited. And it basically gives policymakers a lot more fine tuning over some of their monetary and fiscal policy in exchange for a rapid decrease in privacy and kind of self-sovereignty for individual actors within that economy.
Shockingly so. And yes, don't think that they potentially can't freeze your account or take your money. And again, I hate to get a little bit negative. That being said, and maybe there's ways around it we could discuss with, like we did with Diem or a little bit stable coins. It seems a little bit inevitable, right? Maybe not the next year or two, but 5 or 10 years. I don't really see a way around it. It's coming.
Yeah, especially, China's is virtually out now. So China's they've led the pack, so that's I've even had it described to me by someone that said he's glad that China went first, because now people can see what they're going to do, because they're likely not one of the better actors in that regard, right? So China's big on social credit scores and not big on privacy, for example. And so that's basically kind of an example of things that can happen. And we'll see how that particular jurisdiction applies some of their technologies. But as they likely spread to Europe and elsewhere, potentially into the United States, it is something to watch. And it's kind of naturally progressed from, the centers of power in the current system, right? So the United States and Europe have been more slow to move on this, especially the United States, whereas those that are more interested in bypassing the current system, such as China, have more aggressively kind of spearheaded the efforts there. And so, we'll see what happens with China, but people should really pay attention to the space just because it does change a lot of things how things have worked over the past 50 to 100 years in terms of how the global financial system works.
And two quick hits. One, after one more question, we're getting to asset allocation, some asymmetric bets. Lyn was kind enough to approximately that an hour and 15, 20 minutes. So it's rare to get more than an hour with her. We're very pleased with that. I do know some of you may have to leave at the top of the hour. So we're going to go back to this at the end, Lyn. But for those that want to hear it a little bit live, how could they learn more about your newsletter, your blog, and reach out to you?
Yeah, so I'm at lynalden.com. And I'm also on Twitter at Lyn Alden Contact. And on my website, I have a free newsletter people can sign up to. It comes out every 6 weeks. So I have public articles. And then I have a low-cost premium service that a lot of, it's based so that basically individual retail investors get access to it, but also a lot of asset managers and high net worth individuals also read it because it's basically taking high-level macro information and then making it broadly understandable. And it also goes into individual stock analysis.
Yeah, let me add a little bit to that. One, it's Lyn with one N, Lyn, Alden, Alden. And her Twitter is one of my favorites. It's a star of Twitter, and it's Lyn Alden Contact, like contact someone. And what I will say, I just don't know a better writer. So if you're anywhat interested in the topics we're talking about and about to turn our attention to, she simply is one of the best. You covered inflation, although indirectly. So in the essence of time, we're going to skip over that. Yeah, there are some indicators that could be a little scary relative to that. And absolutely, I guess it could happen, but we really haven't seen it in a long time. If anything, we've been fighting more the opposite, and that's deflation, partially spurred by technology and the advancements there. There's other reasons. We won't dive into super deep detail, but obviously logic would state if you do believe it's going to be deflation, cash and fixed income could be good, where in inflationary environments, it could be horrific. Do you think that we're still going to be battling deflation, or that's about to change very quickly?
So I think, we're still battling deflation this year, obviously, and possibly next year. But the longer you look out, the more actual inflationary pressures are pretty real. And the reason for that is, so a lot of people bring up, they look at over the past decade and they say, why didn't inflation happen, after despite all the central bank intervention, why didn't it happen last time? And so the main reason is because, a lot of the bank balance sheet expansion that happened a decade ago was to recapitalize the banking system. And so central banks increased their balance sheet, but all of that asset purchase they did, all of that kind of, money printing, you can call it, mostly just stayed inside the banking system. And so you saw that, bank cash levels went up, but you did not see broad money supply go up rapidly. And because there was no mechanism to get the central bank printing out into the broader economy. So money supply generally only increases when either commercial banks lend, or if very large fiscal deficits that are mostly monetized by the central bank go around that bank lending channel. And so one thing we saw here in 2020 is that because fiscal spending was so big, and a very large percentage of the bonds issued wound up on the central bank balance sheet with new bank reserve creation, this pretty much went into broad money supply 1-to-1. And so it's something to watch going forward. If we're seeing, this year we saw something like a 25% increase in the broad money supply. That rate has cooled recently, so it's now growing at something like a 12% annualized rate. And we'll see what it does in the future. But if you get a case where, broad money supply is growing at 12% a year, that eventually is likely to be inflationary, especially. So in the past decade, we ended a commodity boom in the late 2000s. And so, during this past decade, the United States, for example, had much slower home building, which is very commodity intensive and inflationary. So that was a deflationary force. You had slower growth out of China, less commodity demand. And we had a lot of supply from U.S. shale oil, things like that really kind of helped keep commodity prices for most commodities very low around the world. And so if you get that increase in the broad money supply, and then any sort of commodity shock related to, we had a lot of capex cuts this year around the world, so we have probably less supply, 2 years from now or so. And so if you get that any degree of commodity scarcity combined with 10 to 15% broad money supply increases for several years in a row, inflation becomes a pretty real concern.
And now it's a little bit showtime, Lyn. I know the single family offices are going to want to hear, we got everything that we built up and talked about, the impact of COVID-19, but again, vaccines on the way, and we could be hopeful 2021 could be shaping up interesting. There have been times you could argue families think long term. I'm not going to quite say set it and forget it, but a little bit, but it's just so obvious now. Good or bad, probably is a time to be tactical for obvious reasons. We're not even quite sure. I agree, arguably fighting deflation, but that could change very quickly, potentially, for all the reasons we discussed. And then it requires a different tactical approach, I guess you could say, to investing. Let's cover a couple of broad asset classes. Why don't we start with single family offices among the world's wealthy that are active in public equities?
So U.S. equities are really kind of bifurcated. So in some cases, we have record overvaluation in tech stocks that rivals what they looked like back in 1999 and 2000. And we're seeing similar IPO activity where we have IPOs being introduced at mostly unprofitable IPOs introduced at extraordinarily high price to sales ratios that in many cases mirror what we saw back in 1999 and 2000. And one thing to keep in mind is that back then many of the companies did end up growing very well and working out fundamentally, but their share price just got so expensive that you didn't really recoup your investment for 5, 10, 15 years in some cases. And so it's something to be, I think, very cautious of is basically public valuations, especially in the tech sector. Now, on the other hand of the spectrum, many things like energy or commodities in general or bank stocks, many of them are trading at average or below average valuations, despite the fact that many of their mega cap tech stock brethren are trading at much higher than normal valuations. And so if you were to get any sort of degree of growth to value rotation, there is some opportunity there for not just following the broad indices. And if you look out internationally, we've had this kind of decade-long period of U.S. equity market outperformance. It also came associated with a stronger dollar. And so historically, whatever market does very well for one decade tends to be not the same market that does very well in the next decade. And so, in the 2010s, we had U.S. equity market outperformance. In the 2000s, we had emerging market outperformance. In the 90s, we had U.S. and Europe did very well. In the 1980s, of course, it was Japan. And so every decade tends to have a different kind of region that does extraordinarily well. And so it's one thing to keep in mind is that we've really kind of pulled this rubber band very tight in terms of mega cap U.S. equities. And so I'm finding more value in some of the emerging markets, in some of the foreign developed markets, especially on a stock by stock basis.
Oops, I was on mute there for a second. And yes, I was going to ask you about emerging markets. Again, if we had more time, but I still have questions, we would dive a little bit deeper, but good points about that. How about fixed income, government bonds, cash?
So that's a very high risk area currently. So of course, it can be used for a volatility damper because those investments can be pretty low volatility and they can reduce volatility in a portfolio. They can give defense against a period of deflation, especially if you have the long end of the curve there, but they have a risk if you were to get inflation. And so interest rates are extraordinarily low. In many cases in Europe, they're negative, and in the United States, they're still negative in a real sense. So when you adjust for official CPI, and that arguably understates inflation, then you're just looking at negative real interest rates. And so basically there's a high time cost to holding cash or government bonds. And so other than for a volatility dampener or for people that are specialized in trading the long end of the curve in short intervals, that's just not a very attractive asset class looking out over the next 5 to 10 years.
And real estate, one heavily impacted by COVID-19 and changing dynamics that we're seeing, especially in retail and office space, which I think is changed forever. But it creates distressed opportunities. And I would think that with industrial, And I know real estate tends to be very local. I get it, and that complicates a more broad answer. But e-commerce, fulfillment centers, storage, I mean, there are opportunities here, especially if you get it at a good price.
Yeah, exactly. I mean, and one of the things, if you look at the typical large REIT indices, it's interesting because they don't look anything like they looked like 10 years ago. So all the names at the top, the heaviest components by market capitalization, they're like cell towers, data centers, and as you point out, warehouses, logistics, fulfillment centers. And so those are towards the top of the REIT indices now, in part because they've been fundamentally successful, but then also because they've gotten more highly valued. So it actually is quite hard to find some of those kind of, quote, no-brainer real estate ideas. They tend to be no-brainer for a reason, and a lot of people have kind of piled into them. So now the valuations are kind of high. So of course there are some distressed, investing opportunities in some of those, the retail, the office, but of course there's so much risk there that it requires a specialist to go down and find out separate the wheat from the chaff. And then in terms of residential real estate, that's also heavily dependent on zip code. So we're seeing, of course, the migration from higher tax states, urban centers, to lower tax states, suburban and rural centers. And there has been a pretty significant period of underdevelopment, just because we had such a supply glut leading up to the global financial crisis in terms of real estate. And we've had a kind of a period of undersupply for a while. And now we are starting to see pretty strong activity in home building, and in just interest in residential properties in suburban markets, rural markets, especially outside of some of the high tax states.
I mean, we have a family office I had as a guest on last week, a little bit of an old guard family office, but very sharp, that looked at New York City, and they're based in the New York City area, and said, it's not quite there yet, but we expect pricing on hotels that were over-levered. People are turning in their keys to the lenders. And if we could get it 50, 60 cents on the dollar, the buildings aren't going to magically float into space. Some of them will convert. The vaccine works great. Let's hope tourism comes back. I mean, they made a good point, assuming they get at a good price and they don't overlever. Let's switch over to VC. It's been very popular with my members in relationships, biotech, deep tech, AI, everything about it. A lot of families are active earlier investors, a lot are active through funds. And I'm seeing a little trend that I've been pushing a little bit for larger scale families with the internal resources, effectively creating their own internal private venture capital arms to make lots of strategic investments.
No, I think it makes sense, especially with the way that public markets look at the moment in terms of high valuations for most of the good companies, and with interest rates and fixed income so low. I do think various alternatives like that are useful for any large portfolio. It's not an area that I put a lot of specialty into, and so I'm sure you have other guests that can talk about that space far more than I could.
And of course, I do have to turn my attention to gold. And some people look at like the 10-year Treasury minus inflation. That is the real interest rate. And again, we're going to get to it eventually, but Tudor Jones would have said that, yeah, gold and these may be good, but the fastest race in this horse is not going to be gold. It's going to be Bitcoin. That being said, there arguably are some advantages to gold for holding in a portfolio. What's your perception of it?
So long term, I like many commodities, including gold, including Bitcoin. And so with gold, it tends to follow real interest rates very closely. So as you measured that, in the real time, it's calculated as the 10-year minus inflation expectations. If you look at historical data, you can use CPI. And so that, gold tends to move inversely correlated to that. And that's, of course, because if you can get a positive real interest rate from treasuries, then there's a pretty high opportunity cost for holding gold, and therefore it becomes less attractive. However, if the real interest rates turn negative, then suddenly that scarce yieldless asset gold becomes a lot more attractive and tends to get bid up in price during those environments. And historically, where we are in the long-term debt cycle, governments are likely to keep their sovereign bonds at negative real yields for quite a long period of time, because they can't effectively pay positive real yields on those without getting into a fiscal crisis. And so those, the bonds are likely over the long term to go back to being called certificates of confiscation, essentially, like they were in the 1970s and the 1940s, which is, you can invest in them, you get your money back, but that money ends up not being, it doesn't keep up with interest rates and taxes on it. So gold is more attractive in that environment. And because gold is something like a $10 trillion market, which is actually still very, very small in the global scheme of things. I mean, there's something like there's over 400 trillion in assets globally. And so gold is still a very small share. And so for big institutions, gold still has certain advantages over Bitcoin because it's less volatile, it's more established, it can hold a larger pool of money. Whereas Bitcoin is likely the fastest horse, but also it comes with more volatility and it comes with somewhat less liquidity because it is this, it's something like a third of $1 trillion rather. So it's something like a 40th of the size or whatever the case may be of gold. It's a much smaller asset class.
And that does segue well into Bitcoin. I mentioned earlier, I'll loop it into digital innovation. Unacceptable in my mind to say I don't invest in what I don't know. This is something that then start to know because obviously there's lots going on. You and I are going to be familiar with all the tailwinds that just really this year have happened. From Tudor Jones to Stan Druckenmiller to Cathie Wood, who's an amazing investor, I'm sure you'll agree. Bill Miller, Michael Saylor at public company MicroStrategy, putting over 450 million of their corporate balance sheet onto it. Square, last week, Mass Mutual, ultra conservative company over 150 years old, putting $100 million to work, or hope to. They need regulatory approval, I think, into Bitcoin. Apple Pay getting involved, PayPal. I think my audience gets the picture. There's a lot of tailwind behind Bitcoin. Like you said earlier, in 2017, you were interesting. I want to watch it, but I'm going to be a little bearish. Tell us about your opinion at the moment. And your 2 white papers this year are the best on 7 misconceptions of Bitcoin was one of them, I believe, and I forgot the name of the other. Fantastic. The floor is yours.
Yeah, so with Bitcoin, I got tons of emails about it back in 2017, and so I eventually covered it pretty late in that bull run. And because there was so much euphoria, I said, okay, the technology is interesting. The biggest risk I had at the time, and aside from the euphoria and the price action, was the risk of dilution. And so ever since when Bitcoin was invented, it solved a lot of hard problems that were previously not known how to solve. So it solved the double spending problem. Basically, it solved the problem of digital scarcity. Essentially, how do you have a digital thing that can't be copied? And so they invented that, but then of course it's open source, it's public, and so once the floodgates of knowledge were opened, we started to get thousands of cryptocurrencies. So anyone can make their own cryptocurrency. You can literally copy Bitcoin. And so the question is, what happens when there's multiple, there's countless cryptocurrencies? Can that dilute the scarcity of Bitcoin? Even if Bitcoin's, has a scarce number of units, 21 million, could there be so many competing protocols that it dilutes capital in the space? And especially because back in 2017, you had the hard fork between Bitcoin and Bitcoin Cash, which is some of the developers wanted to go in a different direction, and so you had these 2 competing versions of Bitcoin, and so that all created risk about dilution. So combined with the overbought condition, I just kept watching the space. Now in the 3 years since then, Bitcoin has been significantly de-risked in my view, and that's because so a lot of that was settled. Essentially, the market showed that Bitcoin's network effect was much stronger than all of those other coins combined. So Bitcoin retained a very large share of the market, and so kind of like how if you were to copy Wikipedia's code and host it, right? So all of Wikipedia can fit on a thumb drive, right? But if no one can just copy Wikipedia, put it up, and then get 1 billion traffic visitors like Wikipedia does, it has a much stronger network effect of links from all the search engines, all the different websites, all pointing to it. And so there's really only one Wikipedia, despite the fact that it's essentially pretty easy to copy. So with Bitcoin, you have the network effect of over 10,000 nodes that are verifying transactions, and you have by far the most mining power that is defending the network against 51% attacks that could potentially kill a cryptocurrency. So Bitcoin has by far the most security and the strongest network effect, which then you can begin to kind of treat it like a tech stock or like a payment network. And so when you have that scarcity combined with the network effect, it makes it pretty appealing. And so since early 2020 here, when it sold off early this year during the March and April sell-off, I became quite bullish on it. And so I do think it's something to watch. It's got a very asymmetric outcome potential. So a small allocation to it, worst case scenario, it goes to 0 or it gets cut to half. Whereas best case scenario is it can go up tenfold or more. And so one thing I would kind of recommend, I think it's kind of one of those things where a picture is 1,000 words. So a lot of people are familiar with the linear chart of Bitcoin. They go back, you can look on anywhere and see the price action over the past 3-4 years. You see the big bubble in late 2017, and you had this big consolidation period. I would urge people to go and look at the long-term logarithmic chart. And you can either look at it in terms of market capitalization or per coin, and it has a very rhythmic pattern to it. It tends to, so every 4 years, Bitcoin, the new supply gets cut in half. And Bitcoin's price action tends to have this very kind of repeated pattern within that 4-year halving cycle. And so we had the blow off top in 2017. 4 years before that, you had a blow off top, and 4 years before that, you had a blow off top. And so the stage that it's at in the halving cycle now is historically a pretty bullish phase for Bitcoin. And that's pretty apparent by looking at the logarithmic chart and then overlaying the previous halving points, which happen every 4 years. So I think that's one of the cleanest ways to look at it. And then from there, people can determine, if they want an allocation or not.
Yeah, that was a pretty deep dive in 4 minutes on a highly complex subject, the one that we're covering a lot, and you're a fan of as well, and he's a fan of you. But on Twitter, Plan B, his amazing charts, you could follow him at, off the top of my head, 100 trillion USD on Twitter. Unbelievable. His charts are great. So if you want to get more educated about the subject, and saying that you don't understand it to me is unacceptable. And like you said, yeah, there's risk. We won't get too deep into it now, but a lot of the miners in China suppose that hash power 51% attack comes from Chinese nationalization, governments, taxes, quantum computing. They're all potential risk. One of the best things is what you said, and I've been saying, maybe for $1 billion family, under 1%, but for many others, maybe 1 to 3%, it's going to be likely worth the asymmetrical trade. On that subject, besides Bitcoin, and besides other things in DeFi and NFTs, which is probably beyond the scope of what we're covering today, what other asymmetrical opportunities potentially do you think there are out there? A couple of our families have brought up that they've been very active in public company investments in psychedelics. So very, very niche. And actually, Tim Ferriss has spoken a fair amount about that. Was there anything else that comes to mind besides Bitcoin, crypto, Ether?
I think one of the spaces worth watching is uranium. And that's because many countries have these goals to have zero net emissions. And we, a lot of us, when we think of uranium, we think that nuclear energy is kind of winding down. But it's actually, over in Asia, it's still building up. So China, India, South Korea, they are greatly expanding their number of nuclear plants. And uranium has been in roughly a 13-year bear market. So it peaked in something like 2007 off the top of my head. And then, of course, you had the Fukushima disaster in 2011. And so you had this period of oversupply. And so uranium has been at a price that is below the mining cost for quite a while. However, that bottomed in 2016, and then it's been slowly increasing since then. It's been hitting higher highs, higher lows. And if you look at the projected supply-demand characteristics of uranium over the next 5 to 10 years, there's a very strong deficit in place, and that uranium almost certainly has to rise in order to bring more production online to keep both existing reactors and the new planned Asian reactors online. And if you look at, for example, China and India, let alone renewables and oil and gas, they're still increasing their coal usage every year. And so, yes. and that contributes to a lot of air pollution. And just because they have such an insatiable demand for energy, and they're still consuming energy at a much lower per capita rate than most Western countries, and so they have just huge energy needs to fill. And then especially if you go more towards electrical vehicles, that doesn't eliminate the need for energy. It just makes it so that you need energy from the grid, which in most countries still comes mostly from non-renewable resources and mostly carbon-emitting resources. So uranium is essentially carbon free, and it's one of those things where it has these headline disasters, but statistically, it's killed fewer people than coal, for example, and over the course of its whole life cycle existence, kind of like an airplane. When an airplane goes down, it's catastrophic, but overall air travel is very safe, and so you kind of have that same sort of binary characteristic with uranium compared to some other energy markets, and so. there are some physical vehicles that you can hold, that they hold uranium, kind of like a closed-end fund. They hold uranium. Sometimes they trade at a discount to their net asset value. And then there's also miners. And so between those two areas, it's a pretty interesting play for a small position. It's just the market is starting to show signs of life and likely has a pretty good 5 to 10 year runway, and is pretty much uncorrelated to anything else out there.
That is for sure. The last couple of questions from me and partially from the audience, maybe we'll keep it 15, 30 seconds so we could breeze through them. Do you agree that a risk that significant families should be concerned about is their custodial and banking relationships? Should they do greater diligence on that?
Yeah, I think so. I think it's good to have some degree of diversification, with the relationships you have, just because, as we go through the next, call it 5 to 10 years, these are pretty turbulent times. And so it's important to be aware of the risks that you don't see coming. So in addition to just the fluctuating prices of your investments, to make sure that, all the custody and all the things like that are sorted out and are very robust.
Family offices and investment committees, do you recommend them?
Yeah, I think, it's obviously a great tool in this current environment, especially, any group that has very large amount of wealth. It's a very strong, it's a very difficult business knowing how to allocate that properly, especially because so many asset classes are unattractive. I mean, equity valuations are so high, interest rates are so low, and therefore allocation to alternatives are interesting, but that's inherently more complex and involves more research and more management.
A significant single family office principal is asking some questions. I'm going to punch them out. He's a lot smarter than me. Here they go. Isn't it true that assets of the U.S. government have increased drastically during COVID-19? The U.S. government owns and regulates the airwaves, 5G, Zoom, streamlining video, makes such airwaves worth many trillions.
Yeah, I think so. I mean, I'd have to deep dive into the details of how those are priced. It's not something I've covered a lot. But yeah, the logic is sound. Essentially, owning kind of that inherent, backbone is obviously more valuable now.
It's more of a wealth preservation question that I'm pretty fluid in, but I would love to hear your opinion. Someone's asking, which countries are the most stable places in which to hold your capital? I guess besides the U.S.
So historically, Switzerland and Singapore have developed a reputation for that. There's different ways to measure stability, obviously, but historically, those two have been very strong for that. And so, I think some degree of diversification is good. So having, not all your eggs in one basket, but those are the two that I would think of, and that, historically play that role.
Completely agree, along with the U.S. And I would say a little underrated, maybe Canada, but we'll save that for a different time. Doesn't Moore's law and technology-based productivity increase serve as a deflationary driver? I think we answered that, but go for it.
Yeah, absolutely. I mean, that technology is inherently deflationary, and it's a good form of deflation, because ideally, you want your money to buy you more stuff. We've had the proliferation of smartphones that have replaced all sorts of gadgets that we need now. Right? There are phone, there are GPS, there are everything pretty much anything we need is in one device now, and layering on additional apps and stuff is virtually free. And so one thing to keep in mind is that Moore's law is getting towards its kind of physical limitations. And so we've seen, for example, Intel has had missteps in terms of getting down to lower and lower sizing, whereas Taiwan Semiconductor has kind of leapfrogged them, and they've been able to get to the 7 nanometer range, whereas Intel has found it very challenging. And just as they get lower and lower, Moore's law starts to run into these kind of foundational physical limitations, until you get into a whole different regime of potentially quantum computing or kind of major breakthroughs.
Sovereign currencies are backed by rule of law, standing armies, and the power of taxation and debt issuance. What backs cryptocurrencies?
So many of them are virtually unbacked, right? So many of them are, the thousands of cryptocurrencies out there. Most of them don't really have any intrinsic value. If we isolate Bitcoin, what backs it essentially is the large amount of mining power that goes into defending the network from attacks, as well as the tens of thousands of nodes that people operate to verify the network and to keep it functional. So you eventually have, essentially what you have is the network effect backstopping that. And so it doesn't peg it to a specific price, but it keeps it kind of inherently volatile, especially in a world where people often do want to move money internationally. They want to be able to hold money outside of the system, and they want to basically have transactions that can't be blocked by any third party. And so Bitcoin has kind of established itself as that protocol, like a foundational layer that allows that to work. And so, engaging its value, looking at the number of nodes, looking at hash power, those sort of fundamentals can kind of provide some sort of context for the health of that network.
Now, Lyn, we spoke about your wonderful website, newsletter, but I believe you also very, very selectively may take on, as an investment committee member or advisor, advising some significant single family offices. You're rather discreet with your email contact online, and I'll leave that for those that want to do a little digging to find it. But how would you prefer for those that may be qualified, that may want to reach out to you other than simply your newsletter and your services? Would you want to give your email, or would they come through me and I'll pass them on to you?
They can go through you. Also, we do have a contact page on our website. And like you said, I mean, due to time constraints, we don't do a lot of that type of work, but we're open to people reaching out and seeing if there's anything we can do to work together.
Yeah, I mean, Lyn is just great. So if you do a little homework, you could kind of find it on the website. But if you simply just want to email me, if you're a direct family member or a single family office, and I'm happy to pass on that info. And again, it's the holiday season, time is tight. And again, Lyn is not hungry for business, but she's great. And if maybe what you're saying is of interest to her, it's an opportunity to interact. She's been incredibly generous with her time. Lyn, I do a close. It takes about 2 minutes. Your time's very tight. If you just have to exit, I completely understand. It's been incredible having you on the show. Look forward to having you on in 2021. And I'm getting so many questions from families and CIOs that this was fantastic. I wish we had more time to do an hour and a half's a lot, but more time to do a deeper dive into certain things. Next time, we don't need to set the stage as much. We could just jump right into some specific opportunities. But it's been great to have you on. If you feel free to move on. My audience, I'm going to give a quick, by Angelo standards, 2-minute close, and we'll move on. So everyone, it was tremendous to have Lyn Alden on the show today. I am a huge fan. You got to check her out on Twitter. That's Lyn with one N, Alden with an A, contact. So it's all together, Lyn Alden contact, and check her out online as well. We've been having an amazing amount of deep macro thinkers and investment strategists on. Raoul Paul, Lyn, who is on right now and today, Mark Faber of the Doom, Boom, and Gloom report upcoming, Jim Rickards, and so many others. We're really in a great period where we're getting amazing guests and bringing great intellect to our people. I am the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association. We're a global membership organization dedicated to families of wealth and their single family offices. We produce a lot of original content, host hundreds of digital programs annually, have actually, because 2 weeks ago I did, am somewhat back in the swing of intimate workshops in select settings around the country. And it's been really fortunate to do what I do for many, many years. If you're a direct family member, CIO, family office executive, I am sure, more so than ever in today's world, that we could provide value, connections, peer-to-peer connectivity, and intellect to have you make proper decisions. Go and subscribe on YouTube. It simply is Family Office. My website is Family Office Association. And my direct email is angelo@familyofficeassociation.com. Look into membership. We look forward to hearing from you. On that note, everyone, have a great day. Thank you.